Hi there, thanks for joining my video. Today we're going to talk about conventional loans, which are also known as conforming loans. They represent about 80% of all the mortgages that are done in the US. Now, the main reason what they call a conforming loan is that they have to conform to two major companies' guidelines, which are known as Fannie Mae and Freddie Mac. And basically what has to happen is your lender out there who does a bunch of loans out there, they're going to sell those loans to an investor, but they have to jump through the hoops of Fannie Mae and Freddie Mac. Now, there's a lot of features out there, and we'll start off with a 97% loan to value. So that means on a $200,000 house, you only have to put $6,000 on this loan. So it's $6,000 down, and so that's a great way of going. Um, that's better than FHA. And you can, if you get better rates though, if you put 5% down or 10%, 15, 20, 25, 30, or 40% down. Once you're putting more than 40% down on a house, you're going to get the lowest possible rate that's out there for your scenario. Now, the debt to income ratio is 49.99%. So what that means is basically your total payment of your house payment, including the principal, interest, taxes, insurance, homeowners insurance, mortgage insurance, plus any credit cards, car loans, student loans, monthly payments, can be 49.99% of your total monthly income. There's, as far as credit score driven, if you have a high credit score, you're going to get the lowest possible rate. So when you can buy a high credit score and a low loan to value, that means you're putting, let's say 40% down, you're getting the very rock bottom rate that's available for you. If you have a low credit score and you're putting a high amount, you're financing a really high amount, let's say only you're only putting down 3%, you're going to have a much higher payment. Now, options as far as it's concerned, there's lots of options when it comes to and designing your specific loan. Now, one of them is mortgage insurance. That's the main one that you can see, is that when you're putting less than 20% down on this mortgage, you have to pay something called mortgage insurance, which is default insurance. That means you make a monthly payment to an insurance company that the lender selects, and what happens is if you default on making your house payment and the lender has to take back the house, they can go to the mortgage insurance company and pull the money out to pay off and be repaid on the house. Now, there's three different options that are available. There's what they call borrower paid, which you pay a monthly amount. So until the loan to value goes below 80%, you keep paying that, and that mortgage insurance premium drops over time. And once the loan to value gets to where you have 20% equity in the house, then it cuts off. The other option is what they call lender paid mortgage insurance, and that means you pay a higher rate for the loan, but you don't have to make that monthly premium. Sometimes that works out better for you depending on your situation. But the downfall on that one is that that higher rate never drops. Now, the third one is something that's neat, is called single premium. And what single premium mortgage insurance is basically you pay a one lump sum up front, and then you don't make a monthly payment as far as mortgage insurance. And then that can really help your debt to income ratio so you can buy more house. Now, these loans are usually very quick. You can close these loans in as short as like 11 days. And basically, you can get what they call reduced documentation. So if you have really favorable circumstances, you don't have to provide as many documents to the underwriter for the approval. Also, you can get what they call an appraisal waiver, which basically means is that rather than do an appraisal, there's enough documentation about that house, the value of the house, that the purchase price that you're paying for seems reasonable to the lender and to Fannie Mae and Freddie Mac. And what happens is that, and if you have a strong credit score and putting a lot of money down on the house, then what happens is that it can give you a appraisal waiver, and you can skip the appraisal, which saves you money and speeds up the loan. Now, the occupancy can be primary, secondary, or an investment property. And sellers tend to like this type of loan because once again, there's not as much in it for the sellers to do. Less documentation, like we talked about before, and you can lock rates up to a year. Now, some of the disadvantages is credit score driven. So if you have a low credit score at 640, you can expect to pay a much higher rate than you would if you had a high credit score. Your mortgage insurance can also be much higher than if you were to get an FHA loan. So that's a disadvantage. Bankruptcy, foreclosure. So what happens is that the time that allots between those periods of time is longer than what it would be for an FHA loan. Borrowers need to manage the transaction, but what I mean is this, is that with government transactions, there's a lot of paperwork that's involved, and the government has their hands in your loan process. And they're also checking up on the appraisal. They're documenting more information from you. Whereas in this type of loan, you are basically responsible for your own inspections and things like that, especially if you receive an appraisal waiver, because there's nobody looking over your back to say, hey, there's an issue, there's mold or anything like this with this house. So it's on you. And also seller's concessions is that basically what happens is that sellers can, um, in some such situations, like if you're only putting 3% down, the sellers can only give you concessions of up to 3% towards your closing costs, where FHA you can do up to 6%. So a basic summary of this product is it's kind of like going to a big restaurant, and it's an overall big restaurant that will satisfy 80% of the consumers out there for what you need in a loan. And it's got all sorts of different options. It's got, cheap steaks, and it's got really expensive steaks. It may have some uh, vegetarian food, but maybe not all vegetarian food. And the best vegetarian versus a small specialty store. So think of your FHA loan, your VA loan, your USDA loan, your jumbo loan as these specialty stores that handles like, these certain products, but this one handles is good enough to handle 80% of everything that you need out there. So I hope you enjoyed this video, and thanks for watching. And if you like it, let me know. I sure appreciate your time, and hopefully we'll see you again in another video. Bye for now.